hear about annuities all the time, right? That big promise of a secure income for life. But you've got to wonder, how safe is the money you're actually putting in? Well, today, we're going to break that down for you, piece by piece. So here's what we're going to cover. First, the big one. Are annuities safe? Then we'll look at who's really backing your money. We'll dive into the difference between fixed and variable risk. Huge deal, by the way. We'll also check out the backup plan if an insurer fails. And finally, we'll help you figure out if an annuity is even right for you.
Okay, let's not waste any time. We're diving right into the question that's probably why you're here.
Yep, are annuities safe? It really is the most important question, so let's tackle it head on. So, the short answer? Generally, yeah. But, and this is a big but, the real answer is all in the details. That's where things get interesting, and that's what's going to matter for your wallet. So, let's start digging in.
All right, so this brings us to the first and, honestly, the most important piece of the puzzle. Who is actually backing this thing? Think of this as your first line of defense, your primary safety net. You know, it's super important to get this straight right away. An annuity isn't like buying a stock. It's a contract, plain and simple. It's an agreement between you and an insurance company. You give them a lump sum of money, and in return, they promise to pay you back over time. Everything, and I mean everything, rides on that contract.
And that leads us to the absolute key takeaway here. A contract is only as good as the company that backs it up, right? So your annuity is only as safe as the insurance company that wrote it. Their financial health is your security blanket.
Now, this is probably the single biggest point of confusion for people. You're used to putting money in the bank, and you know it's protected by the FDIC. That's the government. But an annuity is a whole different ballgame. It is not a bank product. It's backed by the insurance company itself, by its own assets. That's a big difference. It's a corporate promise, not a guarantee from Uncle Sam.
Okay, so checking out the insurance company's financial strength, that's step one. But step two is just as important. What kind of annuity are you looking at? Because let me tell you, they are not all the same when it comes to risk. And this choice is huge. I mean, it's the difference between your initial investment, your principal, being safe and sound, or being out there exposed to the ups and downs of the market. Let's break it down. It really comes down to two main camps. In one corner, you've got your fixed and fixed indexed annuities. These guys are all about protecting your principal. Your initial investment is safe, the returns are predictable. Simple as that. But in the other corner, you have variable annuities. Here, your money is actually invested in the market. So yeah, you have the potential for higher growth, but you also have the real risk of losing money. Your principal is not protected. So really, it boils down to one thing. One type offers stability and protection. The other offers that growth potential, but it's tied directly to the market. Okay, so this brings up that nagging question in the back of your mind, right? What if the worst case scenario happens? What if this super strong insurance company I picked actually fails? Is there any kind of backup plan? And the answer is yes. There is a kind of safety net. It's called a state guarantee association. Basically, every state has one, and it's funded by all the other insurance companies in that state. Their whole job is to step in and help out policyholders if an insurer goes under. But, and I can't stress this enough, this is not a government bailout. It is not the FDIC for insurance companies. The protection you get is limited, and you really need to understand that. So let's be super clear about what these limits are. First, like we said, it is not the FDIC. It's not federal insurance. Second, the amount of protection is capped, and that cap can be different depending on what state you're in. And third, while it's a good layer of security to have, it is absolutely not an ironclad 100% guarantee. Okay, so we've looked at the company, the type of annuity, and the backup plan. That brings us to the final and maybe the most important question of all. Is an annuity actually the right choice for you? Because at the end of the day, safety isn't just some number on a spreadsheet. It's about whether a financial product actually fits your life and your goals. You know, what feels super secure to one person might feel way too restrictive to someone else. So how can you tell? Well, think about this. Are you someone who puts stability above everything else? Do you just want a guaranteed, predictable check coming in? Is protecting your principal from market swings a must-have for you? If you're sitting there nodding your head yes, then a fixed annuity might be a really good fit. But on the flip side, if you're looking for big growth, if you need to be able to get your hands on your money right away,
Or if you're totally okay with taking on some market risk for a shot at higher returns, then an annuity's guarantees might feel less like a safety net and more like a ball and chain.
So when it's all said and done, it comes down to this single powerful question. It's the core trade-off. Is that predictable income stream worth trading away the potential for higher growth? How you answer that is what will tell you if an annuity is truly safe for you.